In the uranium market, there are moments when forecasts and opinions give way to something much simpler, a point where the forces behind the market stop drifting quietly and begin interacting in a way that leaves only one possible outcome. It's not a prediction. It is not a theory. It's the natural result of how reactors operate, how mines respond, and how inventories soften the blow until they can no longer do it. To help investors understand this, we walk through 4 points. Each one describes a part of the system and how it pushes the market towards a break. Taken together, they explain why uranium markets move slowly for years and then suddenly all at once. Let's start with point number 1. Point 1 is that uranium demand does not move. The world's reactors follow disciplined operating cycles. They reload the same amount of fuel at the same intervals, and the cost of that fuel is far too small to influence consumption. When prices rise, reactors do not reduce their burn. When prices fall, they do not buy more. The existing fleet alone guarantees a steady and predictable pull on supply every single year. This is one of the few commodities where the core demand does not contract when markets tighten. It does not flinch in recessions, in inflation, or in geopolitical stress. Demand grows slowly and consistently, and that curve is anchored by physics, not sentiment. And for investors, that's a first important point. A demand line that does not move means any shortage must be solved somewhere else. The price does not change demand in this sector, which means price must instead influence behavior on the supply side. That's the foundation of every uranium cycle. Point 2 is that supply is slow, fragile, and consistently overstated. On paper, uranium supply often looks comfortable. Mines are scheduled to return to production, new developers publish timelines, analysts project capability that rises neatly to match demand. But the lived inventory of this sector tells a very different story. Uranium mines are technically complex, heavily regulated, and prone to delays. Cost overruns are common, ramp-ups slip, actual production routinely falls short of what was forecast even 2 or 3 years earlier. It takes years of capital, permitting engineering, construction, and commissioning before new pounds appear. And even then, many mines do not hit their projected levels. The gap between forecasted capability and real production has been a defined feature of this market. And for investors, this is the second important point. A fragile supply line means the market cannot quickly fix a deficit. Even large price moves do not pull new pounds into the system in time. When demand is fixed and supply cannot keep up, the pressure builds quietly until something else gives. For more than a decade, utilities and traders have absorbed the imbalance by drawing down stockpiles. These inventories came from earlier periods of oversupply, and they've allowed the market to function as though production was healthier than it really was. Utilities use them to delay long-term contracting, traders use them to supply the spot market, governments use them to manage strategic needs. But inventories only move in one direction, down. They shrink slowly at first and then rapidly once utilities realize they're no longer comfortable. And because inventories do not regenerate easily, the moment they reach those lower levels, the market begins to tighten in a way that cannot be reversed quickly. Inventories hide the deficit until the day they cannot hide it anymore. They create the illusion of stability, and then once they fall too far, the illusion disappears almost overnight. That shift frequently precedes sharp moves in price. Point 4 is what happens when these lines finally cross. When demand continues upward, supply continues lagging its forecasts, and inventories fall below the level that utilities consider safe. The market reaches a point where it cannot operate the way it did before. Utilities must secure supply. They cannot wait for the next year's prices. They cannot rely on stockpiles. They must contract, and they must do it aggressively. This is the moment where recognition becomes reaction. Contracting accelerates. Producers raise prices or refuse to sell forward. Traders tighten their offers. Financial participants reposition. And the market resets through price because there's no remaining buffer. Uranium does not drift upward under these conditions. It reprices in steps. And for investors, this is the fourth important point. When the lines cross, the adjustment is fast, not because the sector is speculative, but because the system no longer has the inventory safety net that kept everything calm for years. Equity markets tend to respond at the same time because the underlying constraint becomes unmistakable. So let's bring all these 4 points together. Demand does not move. Supply is consistently overstated. Inventories are only a temporary fuse, and when these forces finally intersect, the market must rebalance through price. For investors, this is why understanding the structure of the market is far more important than watching weekly price movements. The break is not created by sentiment. It's created by the physics of the fuel cycle and the way each part of it ultimately converges with the others. Once those lines cross, the direction of the market is no longer in question, only the pace of investor recognition. If you want the full framework, including the detailed adjustments, the historical patterns, and the indicators that help identify where we are in this cycle, download the white paper below, Beyond the Curve. It expands on everything discussed here and shows how these structural forces translate into the timing of a market turn.